This is the man who saw the 2008 crash coming, the man immortalized in The Big Short. And right now, he is placing the largest, most aggressive bet of his career against the very thing driving the entire U.S. stock market. We're talking about Michael Burry, and his target isn't housing this time. It's the artificial intelligence mega bubble. He's quietly wagered over $1 billion that the American economy, blinded by AI euphoria, is marching toward a cliff, and the details are all hidden in a secret government filing. Why does this matter to you right now? Because the companies he's shorting, Nvidia and Palantir, are likely in your retirement fund, your brokerage account, or at the very least, they're the reason your neighbor won't stop talking about the stock market. If Burry is right, the AI revolution is about to deliver a financial shockwave that will dwarf the dot-com collapse. The latest SEC filing, the legally mandated 13F, just dropped, and it tells a terrifying story. Michael Burry's entire portfolio, his conviction, his reputation, is now focused on one single trade. His firm, Scion Asset Management, is heavily loaded with put options against Nvidia and Palantir. If you're not familiar with the term, think of a put option as an insurance policy. It's the legal right, but not the obligation to sell a stock at a specified price. But when Burry buys them, it's not insurance. It's a calculated, deliberate bet that the stock price is going to plunge, and he's willing to pay the premium to make that happen. The scale of the wager is genuinely shocking. Over 66% of his entire fund, a notional value of $9 or $12 million in dollars, is riding on Palantir Technologies alone. Palantir, the data giant whose CEO, Alex Karp, famously called short sellers absurd. This is the ultimate Wall Street boxing match, the celebrated AI visionary versus the financial prophet of doom. Burry's thesis is simple, and it comes straight out of economic law, the law of speculative bubbles. It states that every time investor psychology disconnects from a company's fundamental value, a painful correction is inevitable. He looks at Palantir's valuation, which trades at a jaw-dropping 384 times forward earnings, and sees not a technological marvel, but a classic bubble priced for absolute perfection. He sees a massive, leveraged risk. Think back to the year 2000. Companies like Pets.com were priced like they would revolutionize the world, completely ignoring the fact that they were losing money on every single sale. Burry is arguing that the vast majority of AI stocks today are the 2025 version of Pets.com, fueled by cheap money and investor FOMO, that fear of missing out, which is a psychological force far more powerful than any balance sheet. This is the conflict at the heart of his trade. The market is saying, this time is different, and Burry is betting $1.1 billion that this time is never different. But Burry isn't a simple doom and gloomer. His portfolio reveals a sophisticated strategy known as the barbell approach. On one side of the barbell, you have the massive high-risk short bets against the bubble. That's the bear side. But on the other, you find the bull side, quiet, methodical purchases of stocks in sectors the market has forgotten about. He's placed call options, the opposite of his puts, on companies like Pfizer and Halliburton. Why? Because these are the beaten-down, low-valuation companies that have sustainable cash flow. They're what's called deep value. When the great rotation inevitably happens, money is going to flee the overpriced AI sector and flood into exactly these kinds of unloved, overlooked, stable businesses. He is not just betting against the economy. He is placing a bet on where the money goes next. The legal implications of a collapse are precisely what Burry understands best. When a bubble bursts, it is never just a stock market problem. It becomes an economic law problem. Consider the law of moral hazard, a concept at the core of the 2008 crisis. Moral hazard occurs when a party is insulated from risk and acts more recklessly because of it. In 2008, the banks knew they were too big to fail, So they took reckless risks with subprime mortgages. Today, Burry is arguing that the same reckless insulation exists in the megacap AI space. These companies have become so central to the US indices and so critical to the perception of economic growth that the assumption is they will always be protected, either by the Federal Reserve's easy money policies or the sheer inertia of institutional investment. But Burry's short position is effectively a legal financial instrument, forcing the question: what happens when the underlying fundamentals, the slow growth of cloud computing, the cost of capital expenditures, cannot sustain the current market capitalization? What happens when a company like Nvidia or Palantir misses earnings not by a little, but by a lot? The legal framework of their existence is stable, yes, but the economic law of their valuation is fragile. The most critical insight from Burry's portfolio, beyond the high-profile tech shorts, is his seemingly small investment in SLM Corp, better known as Sallie Mae. This is a direct play on the student loan cycle. Why would a doomsayer invest in a company tied to consumer debt? Because the student loan market, backed largely by the US government, is a massive, opaque reservoir of risk. If Burry is betting on a downturn in the general economy, he knows that consumer credit is one of the first things to crack. Sallie Mae, a financial services company, operates at the intersection of consumer risk and government policy. It's a quiet way to track the health of the American consumer, whose spending habits drive 2/3 of the US economy. Now let's talk about the practical implications for the everyday American. What does this mean for the person watching this who doesn't trade multi-million-dollar put options? First, it's a vital lesson in due diligence, the legal and financial obligation to fully investigate an asset. Burry doesn't follow the crowd. He reads the footnotes in the 10-K filings and ignores the headlines. If a company's valuation seems impossible, it probably is. You need to question the fundamentals, the cash flow, and the debt, not just the story behind the stock. Second, it validates the contrarian mindset. When you see everyone piling into one asset, one sector, one narrative, the smart money, the Burry money, is looking for the exit. His long bets on value stocks like Pfizer and Lululemon show that the strategy isn't about when the market collapses, but rather, what assets will survive and thrive when the money flows out of the current bubble and into what is actually cheap and generating cash. This is the art of market rotation. The real implication for our economic future is the return of discipline. Burry's bet is a massive challenge to the era of free money and momentum investing. It is a harsh reminder that at the end of every speculative boom, economic law, the brutal reality of debt, earnings, and valuation, always wins. The market may ignore the math for months, sometimes years, but it cannot ignore it forever. Michael Burry has thrown down the gauntlet. He is betting $1 billion that the party is about to end. And he's not just betting against two companies. He's betting against the foundational assumption that the AI boom can defy the economic laws of history. He has placed his chips, and now we wait to see if the prophet of 2008 will be vindicated once again. The only question left is, if the man who predicted the last two major crashes is shorting the market now, what are you doing to protect your portfolio?